more on the Fed decision, let's bring in Fox Business's Charlie Gasparino, John Lonsky from Moody's. He's the chief economist there, and Peter Schiff, president and CEO of Euro Pacific Capital. Peter, let me start with you. The market is celebrating. Are they right to do that?
I don't think so. You know, what's the most significant here is normally when the Federal Reserve begins to raise rates in a tightening cycle, it's early in a recovery, right? You have a lot of pent-up demand. There's a lot of upward momentum. The Federal Reserve has waited so long that this so-called recovery is basically over, and we're about to begin the next recession if we're not already there.
So you choked when she said she was doing this early as well. I was in my office. I almost fell off my chair. John Lonsky.
Well, Peter's right. You know, never before has the Fed hiked rates with the junk bond spread wider than 700 basis points, and that's usually an indication that we're in the later innings of this game. And so I would think that the upside for interest rates going forward is quite limited, both short-term rates and longer-term bond yields.
Yeah, I mean, of course, she was talking about with relation to inflation, and we're talking about in the broader economic cycle, but do you think that she waited too long in terms of the economic cycle, Charlie?
Yeah, and I would just say this. There's no economic rationale. Lou Dobbs is right about this. You know, we had a very spirited discussion earlier on in the day.
The discussion is always spirited with you, Charlie Gasparino.
But he's right. There's really no economic rationale for raising rates now. Inflation's low. We're, 7-year economic cycles. We're probably at the end of this one. We have a commodity bubble that burst, right? Commodity prices going down. Junk bonds are getting hammered. So there's no reason to do it. Unless you believe there are bubbles in the market, and I think this is the problem. You keep interest rates this low for this long. I mean, I know 25 basis points ain't a lot, but it's better than zero.
That there's negative externalities.
Your grandmother is going to go out and buy a junk bond fund. That's what happens.
The whole recovery is nothing but a bubble. We didn't have a legitimate economic recovery. We just had a bubble, and the bubble needs to be pricked. But if you look at all the forward economic indicators, they're all flashing recession. The only one that isn't is the unemployment rate, which is a lagging indicator because employers don't fire people in advance of a recession.
I agree with you, but how about housing?
Well, housing is still a bubble because prices are too high. That's why home ownership rates are at a 50-year low. But this time it's a different...
Then they pick up a little bit?
No, it's a different bubble now because most people now are renting. It's the hedge funds and the private equity guys that took all this cheap money and have speculated in single-family homes that they're trying to rent out. So when rates move up, all these bubbles are going to burst. The bond bubble, and not just junk bonds. There's a bubble in sovereign credit. There's a bubble in treasuries.
And let's just go back to the fundamentals. Even if we go to the S&P 500, throw out all the energy companies that got hammered in the third quarter, the remaining companies in the S&P 500 showing year-to-year sales growth of less than 1%. And believe me, there's no way in the world we are going to continue to see payrolls growing as rapidly as they did.
So did she damage things by raising rates on the backside of what looks like it could be a coming recession?
I mean, I think what the market liked was the fact that she said we may never raise rates again. That's essentially what she said.
I think they're doing QE4 next year. That's the problem. And not because any of this works. It doesn't work. Okay, but we are trapped in this.
Will the market like that, QE4?
Well, the gold market's going to like it.
Let me ask you this. Is the market rallying right now because it seems like she's not going to raise rates much further, or because she said again and again, we have confidence in the economy, we have confidence in the market, we're doing this because we have confidence? You think the first one?
If the market believes in the Fed, the market has a problem. Who could ever forget the subprime mortgage problem is well contained?
You did a lot of trash talking for the Fed over there, my friend Lonsky. You don't have a lot of confidence in them. What about you?
The Fed has no confidence. That's why they're raising rates, because they're afraid to admit they have no confidence. So to cover up their lack of confidence, they're having this symbolic rate hike. But if they had confidence in this economy, they would have raised rates years ago. But then they would have pricked the bubble sooner, and we would have already had the next financial crisis.
That is a grim outlook.
Really what most people will agree on.
But it makes sense,
But based on the economy, there's no reason to raise rates. It's a horrible time to raise rates, except if you need the
bullets down the road. Or if you think later on down the road you're going to need to have the capacity, so you better raise rates.
Cutting the Fed funds rate is pretty weak tea when you deal with it.
All right, I think we're kind of agreeing, which is a little scary.